Hey there! If you're filing your taxes in 2026, you might want to grab a coffee, sit down, and pay close attention because there are some big changes this year that could impact your refund, your deductions, and even the way you plan your finances. Trust me, this isn't your average, oh, here's a deduction you might qualify for conversation. This year, the IRS has rolled out some new rules and some familiar deductions are being tweaked. So it's important you know exactly what's happening before you sit down with your tax forms. Now, before we dive in, I want you to do one thing. Think about the last time you filed taxes. Did you feel confident you got every deduction you deserved? Or were you left wondering if you left money on the table? Well, 2026 might just change that. So let's start at the beginning. First off, the IRS has adjusted some income thresholds, which affects how much you can deduct on certain expenses. This isn't just a small tweak. This adjustment can significantly impact middle-class families and even some small business owners. Why does this matter? Because deductions aren't just a number on paper. They're money that stays in your pocket instead of going to Uncle Sam. And in 2026, the IRS is making these adjustments to account for inflation, cost of living increases, and even changes in healthcare and education expenses. One of the first deductions you should know about is the standard deduction. Now, for years, the standard deduction has been a fixed amount based on your filing status: single, married filing jointly, or head of household. In 2026, it's increasing slightly. For singles, you're looking at a bump from last year's figure to a little over $14,000. Married couples filing jointly will see the deduction rise to just over $28,000. That might not sound like a huge jump, but remember, that's money you don't pay taxes on, which can translate into hundreds or even thousands of dollars more in your refund. But the real story this year isn't just about the standard deduction. It's about itemized deductions. Yes, itemizing has always been a way to claim more, but in 2026, there are a few changes that could make itemizing more appealing than in recent years. Let's break them down. First, let's talk about medical and dental expenses. For years, the IRS has allowed you to deduct medical expenses that exceed a certain percentage of your adjusted gross income, AGI. In 2026, that threshold is dropping slightly, which means you can deduct a larger portion of your medical expenses. This is huge if you've had major medical bills, prescriptions, or even certain therapies that weren't fully covered by insurance. Think about all those trips to specialists, prescription medications, and wellness programs. You may now get tax relief for more of those costs than ever before. Next up, we have charitable donations. 2026 brings some clarification and expansion here, especially for people who donate not just cash, but goods and even appreciated assets like stocks. The IRS is making it easier to deduct non-cash donations, which means if you've ever cleaned out your closet, donated furniture, or contributed stocks to a nonprofit, you could see more money returned to you this year. And here's a pro tip. Make sure you keep a detailed record. Receipts, appraisals, anything that proves the value of your donation. The IRS is paying attention. Now, let's switch gears to something that affects a lot of Americans: home ownership and mortgage interest deductions. For many, this is one of the biggest deductions available. In 2026, the IRS continues to allow homeowners to deduct interest on mortgages up to a certain limit. But here's the twist. There's been a change in how refinancing is treated. If you refinanced your home in 2025 or 2026, your deductible interest may be slightly different depending on the purpose of the refinancing and the timeline. This isn't something to ignore because even a small miscalculation can cost you hundreds on your return. Another change that might surprise you involves state and local taxes, or SALT deductions. For a few years, these were capped, leaving many taxpayers frustrated. In 2026, there's some adjustment here that could benefit people in high-tax states. While the cap hasn't been lifted completely, there's now a slight increase in the deductible amount, which means if you live in a state with higher property taxes or state income taxes, you could be entitled to a bit more back than last year. Now, here's something that's becoming more and more important: deductions related to work-from-home expenses. With the way the workforce has shifted, the IRS is updating its rules for home office deductions. If you're self-employed or a freelancer, you might be able to deduct a portion of your rent, utilities, and even internet expenses in 2026. The key here is accurate record keeping. Unlike before, the IRS is cracking down on overestimates, so you need receipts, bills, and logs that show exactly how much of your home is used for work purposes. Education deductions are also evolving. The Lifetime Learning Credit and American Opportunity Credit are still available, but the eligibility rules have been adjusted slightly to reflect higher tuition costs. If you or your dependents are attending college or certain technical programs, this could mean more money back on your taxes, so don't miss it. Remember, even if you've claimed these credits before, check the updated income thresholds because if you're close to the limit, 2026 rules might allow you to claim something you didn't qualify for last year. And here's one that might fly under the radar: energy-efficient home deductions. Yes, if you installed solar panels, upgraded to energy-efficient windows, or made certain home improvements that save energy, you could qualify for additional credits in 2026. The government is really trying to incentivize green energy, so even if these were minor improvements, they could translate into a tangible tax benefit this year. Now, we need to talk about something that affects small business owners and side hustlers: business expense deductions. In 2026, there are a few notable changes in allowable deductions for things like business meals, travel, and certain software subscriptions. If you run a business from home, these updates could mean more money off your taxable income, but again, documentation is key. Keep a spreadsheet, store receipts, and if possible, track mileage if you use a personal vehicle for work. The IRS is paying closer attention to deductions like these, so accuracy is critical. Okay, now let's pause for a second. You might be thinking, wow, that's a lot to take in. And you're right, it is. But here's the thing, 2026 is a year where paying attention pays off. If you ignore these updates, you could end up missing out on thousands of dollars. But if you plan ahead, organize your receipts, and maybe even consult a tax professional, you could maximize your refund in ways that didn't exist before. Speaking of planning ahead, one of the most important strategies for 2026 is preparing for deductions before the year ends. Many taxpayers wait until April to scramble for deductions, but the smart ones plan in advance. If you know you're going to donate, invest in energy-efficient home improvements, or pay for tuition, doing these before December 31st could impact your 2026 return. It's all about timing. Now, let's talk a little bit about retirement contributions. Contributions to traditional IRAs, 401ks, and similar accounts can reduce your taxable income. In 2026, contribution limits have increased slightly, meaning you can shelter more income from taxes. And for those over 50, catch-up contributions are allowed, giving you an even bigger edge. Think of it like this: the more you save for retirement, the more you save on taxes. Double win. Another lesser-known but important update involves health savings accounts, HSAs. If you have a high-deductible health plan, HSA contributions are higher in 2026, and the funds you contribute are tax-deductible. On top of that, withdrawals for qualified medical expenses remain tax-free, which makes this a triple benefit: lower taxable income, tax-free growth, and tax-free withdrawals. Not bad, right? And here's something that could affect families: child and dependent care credits. These have been adjusted slightly for 2026, which means parents who pay for daycare, after-school programs, or care for a dependent adult could see a slightly larger credit. Again, every dollar counts, and this can really add up if you're paying for childcare throughout the year. Now, I want to take a moment to address a question that a lot of people have. Are there any new deductions that didn't exist before? The answer is yes, and this is where 2026 gets exciting. The IRS has introduced a few new deductions for specific situations, like qualified home energy efficiency improvements, certain pandemic-related expenses, and new tech-related education programs. These are niche, yes, but if you qualify, you could be claiming deductions you couldn't even touch last year. Let's also talk about the digital tools you can use in 2026. The IRS has been updating its online resources to make deduction tracking easier. If you create a My Tax account or use IRS-approved software, you can track potential deductions in real time. This is a game changer because it helps ensure you don't miss any eligible deductions, and it makes filing less stressful. And here's an important tip. Organization is everything. Keep separate folders for medical expenses, charitable contributions, business expenses, and energy-related costs. The IRS loves clarity, and when you're audited, or even if you just want peace of mind, having everything in one place can make your life much easier. Now let's talk a little about missed deductions from prior years. Did you know you can sometimes amend your tax return to claim deductions you didn't take advantage of before? If you missed a deduction in 2025, you can file an amended return in 2026 to get money back. This is especially relevant if you recently realized that certain expenses, like educational costs or medical expenses, were deductible. Before we wrap up, I want to stress one more thing. Consult a professional if you're unsure. Taxes are complicated, and with all these updates in 2026, even a small mistake could cost you. A certified tax preparer can help you navigate the changes, ensure you're claiming everything you're entitled to, and help you plan ahead for next year. Remember, knowledge is power, and a little guidance can go a long way. So, to summarize, 2026 is shaping up to be a year of opportunities for tax filers. Standard deductions are slightly higher, itemized deductions are more accessible, medical and charitable expenses can bring more relief, energy-efficient home improvements and retirement contributions are more valuable, and new credits and deductions are available for tech, education, and childcare. But the key to success is planning, organization, and attention to detail. Here's my advice. Start now. Gather your receipts, track your expenses, consult a professional if needed, and use all the digital tools available. Don't wait until April to scramble. 2026 could be the year you finally maximize your refund and keep more of your hard-earned money. And finally, one last tip. Stay informed. The IRS is making changes every year, and 2026 is no exception. Subscribe to updates, read IRS publications, and keep an eye on the news. Knowledge now equals money later. Alright, I hope this helps you understand what's new with 2026 tax deductions and how you can take advantage of them. Remember, being proactive and informed is the best way to ensure you're not leaving money on the table. Now it's your turn. Comment below. Are you planning to take advantage of any of these new deductions this year? Which ones are most relevant to your situation? I'd love to hear your thoughts. Let's get the conversation started and make sure everyone is prepared to file smarter in 2026. Thanks for watching, stay organized, and here's to a successful tax year.